Hello, today is Friday, October 3rd, 2008, and this is Brian Shannon from AlphaTrends.net. We had the federal government pass their bill here today, and it had zero effect in terms of building confidence for buyers. In fact, the S&P 500 was down $1.78 or 1.58%, finishing right near the lows in here, and it's looking more and more like that this market is headed for that two-thirds retracement level at a minimum. So that level again is 108. And at the beginning of the week, it seemed like an unlikely price objective, but the path of least resistance is lower. Governments can't change that. Big institutions can't change that. They can go on TV and say whatever they want. But the fact remains this market remains in serious trouble and they take time to heal. It's not going to be something that happens very quickly. Again, the definition, as far as I'm concerned, of a bear market is a declining 200-day or 40-week moving average. As long as that moving average is declining, we're still in a bear market. There'll be some big rallies within a bear market as we've seen, but this market remains guilty till proven innocent. You can look at all the oversold indicators. You can look at it from a standpoint of hope and common sense. Who's throwing these stocks away? But it's a global liquidity event is what's happening here, which is why we get oil down. We get gold was up a little bit today, but why we get all asset classes down at once, because there's just a lack of confidence and people are moving into cash. They're liquefying their holdings. And today the S&P 500 gapped higher, rallied up, had another push right up to that declining 5-day moving average, and that's something that I pointed out on my blog today, that that it was up to that level, and that it was something that it was difficult to predict what the outcome would be. We were up at that declining 5-day moving average. When the market is below the declining 5-day moving average, then it's guilty till proven innocent on the intermediate term time frame, just as it's guilty till proven innocent with a declining 50-day moving average on the daily time frame, and guilty till proven innocent when we have a 200-day moving average declining. Again, the 200-day moving average, again, that's more for an investor to look at. As long as that's declining, you got no business owning stocks. I mean, realistically, in even in your 401ks, you can't wait for them to come back, because they'll take who knows how long. I mean, we've barely gotten back into this 2000 level, and then obviously anyone who bought up there is experiencing losses, and it's just, I mean, it's a real mess, obviously, and a lot of people are getting hurt badly, and bear markets are brutal. They as far as bull markets, they say they'll go up much further and longer than people expect, and that's what happens in bear markets as well. So trust only price. Price continues lower. That's what you need to put the faith in, not in people's words, because everyone has the best intentions, but it has zero effect upon the market itself. Yesterday we saw that the Russell 2000 had broken below the year lows right in here that had been so important numerous times throughout the year at that $64 level, and it broke down through that yesterday. Today, obviously, we had follow through to the downside as this market finished down $1.45 or 2.2%. I pointed out the head and shoulders pattern here on the the monthly time frame, saying that the height of this pattern, taken from the breakdown point right here at this $64 level, gives us an approximate, and that was just a conservative target. What I was saying yesterday was $50 a share, and again, it sounds like it's down a lot further from here, but $12, that's what is about another 20% or so. This market again remains, it's broken. It's guilty till proven innocent. Let's look at Fibonacci on here. We've seen that actually that 62 level rather, is also the location of that 38.2% retracement. If this market drops down towards the 50% retracement level, you're looking at approximately 58.5. But the most important thing to focus on is the direction of the lows and the highs. And obviously we had this resistance up here. This was a big turning point. The inability of the market to get to move above this level in here that had been prior support, and support broken tends to act as resistance, and just another textbook case of that right in here. But the Russell 2000 looks like it should continue lower. There's no reason to look at this as anything but bearish. We've got a clear downtrend on the 30-minute time frame. We've got the declining 5-day moving average. We've got lower highs and lower lows. For any type of bounce to materialize, we're going to have to obviously reclaim this $65 level. We need to see this 5-day moving average flatten out and the market get above that. And right now, again, as I've been saying, there's just zero evidence of any bounce about to materialize in here. There's just seemingly, no place to hide. Gold was up 26 cents, trying to stabilize near this 50-day moving average, which is declining. And you can see, was this a bull trap? We'll see. It's a lot of people want gold to go higher, and it makes sense that when the end of the world comes, that people go to gold. That's the traditional store of value, but prices aren't supporting it in here right now. Maybe getting back above 83.5, then we can start to work on that 5-day moving average. But that's still declining, so it's still not quite ready to make purchases in gold. We're going to need to see something catastrophic in this market to really get the fear into the S&P 500, the Russell 2000, the financials, the semiconductors, etc., before this thing is going to be over. And there's still apparently a lot more pain ahead. The semiconductors, for their part, they were only down a penny today, but they're clearly still, there's nothing obviously bullish about that. We've still got a very severe downtrend. We're right in here at these levels that we had seen, that basically, once the market took out that little level, and in particular here, this is really where I consider the bull market to begin, is when that 200-day moving average flattens out and then it makes a higher high on this time frame. So right here is where that bull market began, and then basically here's where it kind of officially ended, and then we've just been in this giant mess. But now obviously in a bear market here, lower highs, lower lows. Maybe you could draw a channel off there and say that maybe there's potential support, but again, there's no, when the market isn't in a downtrend, looking at support levels are just potential support. They're an area where you may encounter some buying, but it's not a reason to buy. In order to buy, you need the market to turn around, and you need to see some momentum. And for the semiconductors, maybe above 24, we get a short squeeze rally. And then the most important job is not to identify the correct place to make a purchase, but the most important thing after that is how the market reacts subsequently. Does it break out, pull back, and then continue to rally, or does it just completely fail and you fail to take action? It's up to you to take the responsibility to say, okay, I'm going to buy it as it breaks out, but if it pulls back, I've got to get out. I've got to listen to the message of the market, because it again is the only truth there is out there. Financials, let's take a look there. The XLF was down 77 cents. They remain in a weekly downtrend, maybe searching for support, more neutral than anything, but still just a giant mess. No reason to get involved. The EFA, which is the global index, basically, let's see, this is the EAFE index. It's a composite of world indices. I'll post exactly what it is because I'm not describing it very well, but basically it's not just the U.S. that's getting hit hard in here. And if you were to see a Fibonacci retracement of 2/3 on this EFA, let's take this because that doesn't look like a real high right here. It looks like a bad print. But if we take this high down to the 2003 lows, we're coming into a 2/3 retracement near 51. That's also kind of coinciding with the retracement level on the SPY. So maybe we are coming into an area for a bounce, but again, there's no reason to be an investor, that's for sure. But aggressive traders, it gets harder each day to sell short. It does for me, at least, because you look at the stuff and you say just in disbelief and say, how much further can it go? But it's got nothing to do with logic. It's forced liquidations. It's you're going to be reading more about more hedge funds that are going out of business and that sort of thing, and that are have been forced to sell. So the Nasdaq 100, This market, again, it also came up to its declining 5-day moving average, or very close to it. That's where I had also pointed out on the blog that it was down to, or I'm sorry, that it rallied up to this trend line, and it was below the declining 5-day moving average. So hopefully you're looking at the blog during the day to see these updates. But it had broken down back below the VWAP right in here, came down, retested it, and then as it became apparent that the sellers were defending that VWAP, then it basically closed at the lows. And I'm just going to end this by saying that you can look at these levels and say that's where support is. And in hindsight, it might be support, but people were thinking that here. People were thinking that at all different levels. Support is only known after the fact. It's just a potential level where the market may decline to, and that's what these Fibonacci levels are. There's no magic in any one indicator or oscillator or PE ratio or any other traditional value of measurement of value. As far as does fundamental analysis work? Does technical analysis work? You can't take any of them in a vacuum, but the most important thing, the only thing that pays is price, and that's where 95% of your analysis should be focused.